Well, let's get started. Today we are excited to hear from Martha Stokes from TechniTrader. We have a lot of help in the room today. I know that a lot of your questions will be answered either via text, so look for those answers as a private chat, or we'll be able to field those questions for you after the presentation. What we're going to talk about today, Martha's topic, is Ride the Velocity Express of High-Frequency Trading Action with MetaStock Charting Software. Before we start, I need to go ahead and read our standard disclosure. Please bear with me a moment. This demonstration is designed to instruct you on using MetaStock software and accompanying plugins. It is not a recommendation to buy or sell exchange-traded instruments, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented should only be used by investors who are aware of the risk inherent in trading. Thomson Reuters shall have no liability for any investment decisions based on the use of their software, any trading strategies, or any information provided in connection with the company. Let me introduce to you Martha Stokes. Many of you in the room know who she is. You know her very well. For those of you who don't know, Martha Stokes, C.M.T., she is the co-founder and CEO of TechniTrader, an educational firm dedicated to helping small investors and retail traders. Since '98, TechniTrader has taught thousands of beginners to professional level traders how to be consistently successful in the stock and options markets. Martha's fascination with the markets and business started at the age of 9. She made her first investment while still a teen. Her theory on cycle evolution is a landmark work on financial cycles. She has been involved in several startups and has sat on both sides of the venture capital negotiating table, worked on an IPO, managed a small fund, taught at community colleges, and has been a guest speaker at numerous seminars and investment groups, including the Boeing Employees Investment Group. She's also been a special guest of the CFRA Radio Ottawa, Canada. She's also been a special guest for MetaStock as well. Her long list of educational work include 15 stocks, investing, and option courses, 16 semester-length lab classes, her annual new technology reports, sector and industry, and special edition reports, hundreds of articles, resource papers, white papers as well. Martha writes 6 newsletters each week and is still finding time to answer her individual student questions. We're really pleased to have Martha with us. I'm going to go ahead now and turn the time over to you, Martha.
Thank you, David. It's great to be here. Hi, everyone. Welcome to Ride the Velocity Express of High Frequency Trading Action using MetaStock charting software. And I'm just so impressed with the work that they've done with MetaStock recently. I was at the MetaStock conference as a speaker, and they pretty much wowed me on all the new information that is available in MetaStock and how easy it is to use, which is the primary purpose of getting a good charting software, is to have something that is simple and easy to use, because your job is to trade and make profits. And so I'm really delighted with the MetaStock charting software and how it's been growing. So we're going to take a look at high frequency trading today. As always, this is copyrighted and protected material. You may share it with your family members, but you can't sell it. As with their disclaimer, I am not a recommendation service. I'm not telling you what to buy or what to sell. I'm trying to educate you so you can make your own decisions. I'll explain more about TechniTrader at the end of this for those of you who do not know. Okay. There's a hands-on workbooklet. If you go to the TechniTrader website, you can download that, and you just click on that image, and it will take you to this page. And this page, you have 2 areas where you can download that workbooklet. I would recommend that you, if you don't have it now, that you download it after the webinar, and then just review the webinar and go through it and make notes as you go through it a second time, because it is pretty pithy. Most people feel like I'm throwing a fire hydrant at them of information, but I always like to have a complete training session and not just helter-skelter tidbits of information. So it'll go pretty rapidly. My goal in teaching is to give you tools and skills you can use in your trading to enhance what you already know. I am not trying to change what you're doing. I'm trying to improve what you're doing, because it's very important that you trade well. You are an integral part of the market, and when you trade badly, it hurts the entire stock market. The best way for you to learn is not simply to observe, but to always participate in the training. Just talking at you is not going to teach you anything. So today we're going to do classroom work using your workbooklet, so you have something to take away with you. If you do not have the workbooklet, you can download it after the training today. Okay, if you have less than 2 years of live market experience trading stocks and options, that means that you're actually trading real money in the market for 2 years. You may feel overwhelmed at times during this training. Do not try to learn everything in this short period of time, because you can't. Just focus on one aspect of the training and learn it well, and then review this. They are recording it, so you'll be able to review it as often as you wish. Experienced traders, take notes. You only retain about 20% of what you hear, so I won't be able to hear you scribbling, but I hope that you will be writing notes, because it is my intention to teach you something today. The professional side, let's talk about market structure basics. The professional side of the market is very different than what most retail traders think. The retail side of trading is a small world. The professional side is gigantic, spanning the globe in numerous interrelated financial markets. In order to be consistently successful, which is my goal for you, you must understand the basic structure of the global stock and financial markets. And wherever I go, I am shocked that you don't know this stuff. So some of you, this is a review, but we will be going through it. Charles Dow wrote what is now called the Dow Theory in the 1890s as the Wall Street Journal articles that were accumulated and put into a theory format. He saw that he was walking along the ocean one day, and he realized that the stock market with its surges upward and its waves back was very much like the ocean. So he created this theory. In his day, in the 1890s when he wrote it, the informed buyers, banks, wealthy individuals, and corporations accounted for 50% of the market activity. So 50% of the orders and the flow through the stock market. Before the 20th century, in the late 1900s, there was about 50% were in what he called informed buyers. In other words, these were what we call the institutions, or the wealthy investors today. The average investors came in on the dip. The informed buyers and wealthy investors pushed price up to a certain point, then it slacked off a little bit. Average investors came in at 40%. These were the average people that were businessmen or people who had a little bit of money to invest in the stock market. And then at the very top of the wave, uninformed investors, the people who came in on speculation, know the market's running, so I'm going to get wealthy, I'm going to get rich overnight. They came in at the end, they accounted for about 10%, and then they came in as the informed buyers were starting to sell. This is the basis for all of technical analysis. This is the premise of technical analysis from the beginning. This is what started technical analysis. It's what the basis for Elliott waves and Fibonacci and Gone and all those tools that you use. This theory is what it's based on, and here's the problem. The cycle of market participants has expanded, and it has expanded dramatically over the last few years. It has grown into 9 distinct different groups that you need to understand and learn. Today we're just going to be talking about high-frequency trading firms and not the others. But I do want you to be aware of the fact that the dark pools are the ones that get in early, and the high-frequency traders chase the dark pools. And we'll talk a little bit more about that in a minute. Nowadays, the institutional side of the market accounts for a whopping 80% of all the activity in the market, while you account for a mere 20%. Retail traders, individual small lot investors, and odd lot investors who are the latecomers to the market. They're always the ones that want to get rich quick, and they come in at the end and they lose a lot of money. So as a retail trader, you are part of this smaller group that gets in late. You always get in late, and the reason is because you don't understand how to find the big institutional investors, the mutual funds and pension funds that control trillions of dollars, both in the US and globally, and they really control a lot of money, and what they do impacts the market greatly, and what they buy, what they don't buy. And high-frequency trading firms are always chasing the institutional dark pools. The reason the dark pools were developed was because the high-frequency traders would get in ahead of the big institutions and trade the price up, and the institutional investors were furious, so they insisted the exchanges put together a program so they could be off the exchanges where the high-frequency trading firms couldn't find them. So, how market participant cycle is created are the market conditions. There are 6 distinct market conditions in our modern market structure. There's the bottoming market, velocity, moderately trending, platform, trading range, and topping market conditions. So which one are we in right now? My students know this because I've told them numerous times. We're in a platform market condition because the indexes, the Dow, the S&P 500, and the NASDAQ, the stocks that the institutions hold for the long term and the small investor and the retail trader buy to invest in, are always stocks that don't move a lot, and they're in a trading range right now. But we're in a platform building market because there's value oriented. Fundamentalists have surged forward, and it's a very fundamental market. These distinct market conditions are created by the market participant cycle. So as this cycle develops over 9 different groups, they create this market condition. Right now, we have the dark pools dominating the activity and controlling price. They always control price. That's why it's important to look at different indicators other than the price indicators that you're so fond of. You don't have to get rid of them, but I would like you to consider using other indicators as well. Where the market is in that cycle dictates market conditions. So where we are in the overall market cycle is where we are in the market conditions. What I've done, and it took us several years, we worked on this a long time, and these are specifically for MetaStock charting. They're not available anywhere else in this particular format. We developed them specifically for this. I had a programmer write and work on this with the MetaStock people, as we have 7 different explorations that we have for our students. And what I do is I want to do a market condition analysis, and every day I look at these 7 different explorations, and I look at the numbers. And the numbers tell me what market condition is present at this time. So what I'm doing is I'm asking the market to show me all the stocks that are moving with momentum to the upside. How many of those are there? How many stocks are moving with momentum to the downside, or being sold short or selling off? This gives me a comparison between the buy side and the sell side, and it tells me where the momentum is, where the bias is. Now that is totally different than the indexes, and this is very confusing for a lot of people who aren't my students. But the indexes don't tell you the bias of the market. They just tell you what a few big name stocks are doing. And so you need to really look at the underlying stocks, the small caps and mid caps and everything. And so this is what these explorations do. And so by having this, I can say right now that the momentum buy side dominates and the sell side has no activity whatsoever, even though there's some profit taking. It's not a momentum sell side market. Then I want to look at how many institutions are in and what kinds of institutions. Is it dark pools, is it high frequency traders, and how strong are they? Then I want to know how many stocks are in bottoming formations, long term, intermediate term, short term, so that I can see where the institutions are, because bottoms are formed by institutions. The dark pools create the bottoms. You need to write this down. The institutions that use dark pools create bottoms. Then I want to look at consolidations. How many stocks are in consolidations? Because consolidations are a tightening of a sideways price action, and compression patterns, a lot of you call them wedges, I call them compression patterns, occur before breakouts and big moves. This is because the dark pools are controlling price more and more and more just before those breakouts occur. Then I ask how many stocks are in an overbought pattern, in a cyclical pattern, or a trading range pattern. This tells me if we have a trading range market condition or a lot of stocks stuck in sideways patterns. And this is important. This often cues me before an actual momentum sell starts occurring. Then I ask for stocks with RSI strength. I use RSI, the indicator, to give me exposed platform building conditions. A platform is a new type of sideways action that has started to develop in 2004, 2005 was when the first I identified it. It's new because of how The market structure has changed in how the giant institutions are now trading and buying and selling stocks. So a market condition will tell us who is in control of price, which of the 9 market participants control price, because it's any time during the market cycle, every single market participant group will control price at least for a short period of time. What technical patterns are most prevalent? The different market participant groups develop different technical patterns, and you can identify their footprints after a while. How will price behave at resistance and support? You can't just say, oh, this is strong support or this is weak support, because it changes based on market condition. Sometimes you'll have stocks blasting right through resistance because you are in a velocity speculative market. What trading styles work best? My students have a tendency to use swing and position trading most of the time. Some market conditions are not conducive to certain types of trading styles, and you need to be aware of this because it's harder to trade in those styles. What entry and exit signals will work best? Just because you have a certain candlestick entry signal like an engulfing white doesn't mean that it's going to move up the next day. If it's a trading range market, it probably won't. So you have to be aware of which entry and exit signals you should be using for the market condition that you have. What indicators to use? You don't want to use an oscillator. In a moderately trending or velocity market, a price oscillator is an overbought, oversold trading range indicator. Conversely, if you're in a trading range, you want to watch and not be using velocity or momentum indicators because they will not give you the information you need. So you need different types of indicators for different market conditions. And this is a common problem. Someone will fall in love with a couple of indicators and they use them all the time, and then they wonder why they have such lousy results with their trading, and it's because they're not adapting to changes in the market conditions. Market condition analysis is derived from the market participant cycle. Which market participants are active at this time, which market participants are sitting on the sidelines waiting, who is controlling price, how does price behave when that group controls price action, how does volume react when that group controls price, and are dark pools active, are high frequency traders active? There's a lot of information that you get that tells you how to trade. High frequency trading is a huge sector in the global financial services industry. It is not limited to the US or any other one country. HFTs are not going to go away, folks. In fact, the sector has been growing exponentially. But what is happening is the governing bodies of the financial markets are investigating HFT practices and creating rules and regulations in order to maintain an orderly and fair global market system. HFTs are currently facing many new regulations and requirements, in particular from the United States SEC. And you're all going to, those of you who aren't familiar with me, you're all going to say, well, how come they don't provide the rules and regulations before this? Because they didn't know how HFT trading was going to react in the marketplace. They didn't know how it was going to behave. They didn't know what it was going to do or not do. In order to provide rules and regulations, you have to understand what the new technology is doing to the marketplace. So now that they understand this, they can set up the rules and regulations. High-frequency trading firms are not day traders or floor traders, nor are they actual human beings placing orders. HFTs are computer-generated order processing systems that use algorithms to search for order flow that can be exploited to the advantage of the HFT company. There is no trader pushing the buy or sell order. It's not happening. It's a computer, strictly computer. HFTs trade all financial markets across the globe in every country. The algorithms are designed to find even the slightest arbitrage or cluster orders and trigger automated orders on those against that or trading against or ahead of them. HFT trading is completely automated. Algorithms are written by quants who create programs based on quantitative analysis formulas that seek out sets of criteria to trade ahead of or against. Formulas created by quants are highly secretive, proprietary programs that each HFT company holds exclusively. So all that gobbledygook that you read on the internet about retail traders being able to have HFT formulas is bunk. If there's an HFT formula out there, they're not using it anymore because it stopped working. These are closely guarded intellectual properties. They do not share with anyone. They do not, one HFT firm will not share a formula with the other one, because once it gets out, then it stops working. Formulas are based on a complex set of criteria designed to find specific patterns in and between financial markets. So they're very complicated, and they use extremely high-powered quad processors that you don't have. HFTs trade on the millisecond. This means the HFT computer can fire off 1,000 orders per second or 60,000 orders per minute. That is 60,000 times faster than a retail trader is able to trade. The typical retail order is required by law, U.S. law, to be executed and filled within 90 seconds. So you cannot trade against them, folks. Not a possibility, but you can trade with them. You do have a decided advantage. Since institutional algorithms are computer-generated accumulation or distribution order flow, their patterns are predictable and tend to repeat, which is what technical analysis is all about. Repetitive price action allows you to prepare for sudden momentum moves. This gives you the edge you need to be able to enter prior to HFT action. Many HFTs chase giant fund dark pool buying and selling. The dark pool is off the exchange, often its own over-the-counter transaction with its own institutional broker connected with the exchanges. The exchanges are making money off of it, but they have their own separate little area. And this is dark pool activity. These are their orders right in here. This is high-frequency trading after they discovered that the dark pools have been buying quietly. Dark pools buy in a bracketed controlled order. They have a price range that they buy within. They won't pay less. They won't pay more. And they may move up the chart a little bit as it gets better, but that's how they do it. They control it. And that's what makes it so wonderful, because you as a technical analyst can see this. High-frequency traders drive price up. That's their goal. And then they drive price down. And at the very top are the retail traders and the small lot investors, all getting in late. Okay? So that's what it looks like. Lots and lots of trades. Because of their rapid-fire, high-volume trading strategies, HFT footprints are easy to identify in charts if you use hybrid indicators written for the modern electronic financial market. And when I joined MetaStock as a partner, what we did is we decided to write different indicators for them and have these different indicators developed, because I saw that you really needed to have these different indicators. So we have colored volume bars with a moving average. We have TTQA, which is an accumulation distribution indicator showing what side are the large lots on. We have TTVA, which is an incremental volume analysis. It's a volume oscillator on the center line. And we have TTFF, which is a flow of funds indicator. This tells us what's going on in the market. So usually, not always, an extraordinarily long candle forms. You can always tell if the HFT has failed with its trigger order, because long candles won't form. Volume exhaustion patterns are common. TTQA rises suddenly, often extreme to the top of the chart. TTVA spikes, often hitting the top of the chart. How to find setups for HFT action. Dark pools are off-the-exchange transactions that are not required to post to the market maker limit order. Books during the day. They are required to have all their transactions go through a clearinghouse, however. The orders are delayed and they are recorded. That's required by U.S. law. These are the giant lot orders of the market, 50,000 shares to 500,000 shares lots. Institutions who use dark pools buy millions of shares over an extended period of time. HFTs are constantly trying to find these huge lots to trade against them. This is a war between dark pools and HFTs, and you do not want to get in their way. HFTs chase dark pools. Okay, so write this down. Dark pools get in first. HFTs chase dark pools, because dark pools, once they've bought all they want, then they suddenly let the HFTs know that they bought, and HFTs drive the price up for them. And when the HFTs get into a stock, small funds, and there are thousands and thousands of small funds, and retail traders chase the HFTs. because you're all trading on news if you're intraday. So this is, I'm just not used to this software. You can see that you have an image there and you have small icebergs up above and a huge iceberg down below. So this is representational of what we see as far as dark pools are beneath the surface of the exchanges going on, but everything they do has to be recorded and gone through the National Clearinghouse. So what we see is we have platforms. And we have a platform that forms, and it has quite accumulation. TTQA is at the bottom of the chart. You can see the green bars rising, and then they fade to gray or fade altogether, and then green bars come in again, and then they fade. This is quite accumulation that is going on. Then all of a sudden, there will be a little bit of a black candle at the very end before the high-frequency traders come in. And this shows us right here, this is very common to have a little candle that's dark before the high-frequency traders come in. And they blast price. They also open gap price, volume spikes, TTQA spikes, and then small funds and retail traders try to come in as the high-frequency traders often are selling. And this is what we see all the time. So let's review a little bit. Okay, I'm not accustomed to this software. So what we have is we have a dark pool, we have a huge high frequency trader, downside, sell off, gap down. So then all your small funds are selling off. Then all of a sudden dark pool activity, and you can always tell dark pool activity. How can you tell dark pool activity? Two ways. First, they don't move price. It's in a very controlled bracketed area. And then there's also the TTQA, which exposes their activity. And then small funds later on will drive this price upward. So that's how you check that out. High frequency trading is easy to see in your charts, determining what formula or trigger they are using. In their formula is also in the chart patterns. Here are the current common formula-driven trigger signals. Please write them down because they do change. Dark pool activity that crosses into an exchange transactions or that is exposed after the accumulation period. In other words, sometimes there's a sell-side institution that wants to accumulate 10 million shares of stock because they have to build a trust for a derivative. And there isn't enough stock in the dark pools to sell to them. So it will cross over into the exchange, and the high-frequency traders will find out about it. Retail economic news that the quantitative analysts have predetermined will create a specific reaction from the retail crowd. They love you because the retail crowd is very highly emotional and react to news. And so they can write algorithms to get in ahead of the news and drive price up or down. Earnings reports pre-news release were right at the first day of earnings reports, and they absolutely love earnings because retail traders and your small lot investors, your independent investors are going to be racing to buy stocks on good earnings, and they're going to start selling. Company news that would create a predetermined retail crowd reaction. They pretty much know how the retail crowd reacts because they study what you do. Overseas market activity prior to U.S. market open. If there's something selling off overseas, a lot of times you'll see pre-market activity. I really watch a lot of pre-market activity these days and try to let my students know wherever I see huge trading activity before the market opens. So we're going to have some classroom exercise trading conditions so that you can experiment with some of these things. So what I do for my students is early in the morning I write what's going to happen at market open and also the market condition for that day so they know how to trade. So on this particular day for our classroom exercise, and this is just for the classroom exercise, I would say market is going to open mildly up. The underlying stocks are moving with momentum due to high frequency trading activity. The indexes are in consolidation patterns on low volume. They're stalled. They're not doing much of anything, which is pretty typical of what they're doing right now. The indexes aren't doing much. 50 points up or down for the Dow is nothing. It's peanuts. Institutional scan. Dark pools are active in many charts. We see the quiet accumulation footprint on the price range and the TTQA and the TTVA. We know that the dark pools are entering quietly with no one knowing that they're going on, but they can't hide their footprints from the charts. Remember that only 20% of the market actually is heavily technical analysis, and even less than that. The giant funds do not use much technical analysis at all. And this is a shock to most retail traders who think that everybody uses technical analysis. They don't. I spoke with 5 or 6 of the top banks in the world, and these were the top technical analysts, the top in their fields, working for the top banks, the largest banks in the world. And I said, well, how large is your technical analysis team? And they said, well, right now we have 3. Right now it's just me. We did have 10, but after the banking debacle, they decided to get rid of us. Momentum buy scan is above average with high-frequency trading activity chasing dark pools out of consolidations and bottoms. The trading bias, this tells you what side the dark pools, the large lots are on, is to the upside with strengthening energy. So there's an underlying energy building that the indexes are not showing at all yet. There's no sell-side momentum. Consolidations are the most common pattern, meaning prices compressing. Some trading range big blue chip stocks. So some of the big blue chip stocks are in trading ranges. The trading conditions are swing to momentum energy triggered by HFTs, dark pools buying in short-term bottoms and in price range. So we're going to do some classroom hands-on exercise. We are now going to study different charts to determine who is in control of price. We will also do 2 simulated trades to give you experience in chart analysis for finding HFT activity before price moves. So we'll simulate trade a couple of stocks to see how you do. Trendline patterns, quantity indicators, hybrid indicators all factor into the decisions. We are not using any price indicators other than the candlesticks, as these do not provide leading indications of HFT activity. If you want to be part of the HFT activity and ride these big moves up, you need to learn to find them through volume indicators, because that's the only way they're exposed before the price moves. So we have high frequency trading activity right here, the long white candle, the very long volume bar, very long volume bar, the very long TTQA, TTVA heading up, and TTFF also heading up. So this is a high frequency trading footprint on this chart. And if you learn this footprint, you'll be able to identify where they are. And small lots, investors, small funds, and retail traders chase high frequencies. So we have a chart. I'm going to repeat, this is one that we saw before. We have a gap down caused by high frequency traders. Volume tells us this, the huge gaps tells us this, and we have some activity in here from the dark pools, and the high frequency traders don't know this. And so now there's a selling spree going on, and it's small funds selling. Small funds always do exactly what the high frequency traders are doing. So the high frequency traders sold, so now the small funds are selling. I'm in panic mode. But there's dark pool activity in here. And so that gets to a certain price and it triggers their price, and look how nicely rectangular this price pattern is, because they're quietly accumulating. And then all of a sudden high frequency traders go, uh-oh, they're actually buying. So they jump in to buy, and then the same day they're selling off, because you have retail traders and small funds buying, and so the high frequency traders sell it down, and then small funds move it on up from there. And that's how you read the chart with those indicators. And so small funds are moving that price up, not the dark pools. And that's all small fund activity. So who is controlling price? We have a dark pool, high frequency trader activity. We had some selling going down. Now we have a huge spike of volume. We have a long black candle. This is high frequency trader activity. The small funds sell, but look what happens. Price doesn't go anywhere. The dark pools are already in this, and they're buying. The dark pools are already in here when they're still selling due to the high frequency trading selling, and it's not going well for them. Those small funds are losing money on that selling because the dark pools dominate, and then the dark pools come in and really control price, and it starts to move up. Okay, that's your shift of sentiment. Write it down. Shift of sentiment of TTQA tells you that it's gone from the panic selling mode of small funds to the quiet accumulation mode of dark pools. That's a pattern you'll see over and over. It's pretty new. I've been showing it a lot this year. It's a very important one. And so then we have the high frequency trading volume, huge volume spike, as they suddenly realize that all during this time there's been quiet accumulation going on and a huge spike in TTQA. So again, we have very consistent highs and lows. This is the footprint of the dark pools. And they are quietly accumulating, and price will go up a little bit to a resistance high. But as it retraces, because professional traders and other institutions that are trading short term are taking profit, it comes right down to that price point level that the dark pools were buying in before. And what happens? Dark pools start buying again, and then when the dark pools are through, high frequency traders find out and drive price up all during that final phase. This is all high frequency trading activity in this, and then small lots and retail traders chasing the high frequency traders. So this is how it goes, folks, and it's pretty common. You have, let me review this so you understand it again. You have a platform. This is the sideways action that is a counterbalance. There's still small funds and small lot investors selling because, oh, the world's coming to end. The stock is never going to go up. I can't stand any more pain. I'm selling. While they're selling, the dark pools are buying because they know that the company is starting to do a turnaround. They like to buy. They create bottoms, and they buy in a controlled bracketed order. They have a specific price range, and it's very precise, and they seldom go outside of it. They also have the TTQA, which has the green bars to gray bars to green bars to gray bars, and this is how they buy. They'll buy incrementally. If the price goes out of their range, they'll stop buying. High frequency trader firms, their trigger orders, their formulas will find this activity periodically and try to drive price up. Didn't do much in here, but it certainly drove it up here. This is all high frequency trader volume patterns on both the volume and TTQA, and some short-term profit taking at a resistance high by professional traders driving this price down. But as soon as it gets into the price range of the dark pools, they're back in buying. Okay, high frequency trader, long white candle, huge volume, huge TTQA. Okay. Who is in control of price? We can see with the red arrow that we have a long white candle, huge green volume, even though there's a little bit of red selling going on here in the TTQA, that's small lot selling at the wrong time. As you can see, this is a beautiful bottoming pattern developed by the dark pools. They've been buying since this shift of sentiment occurred right here. Small funds were dumping. Dark pools moved in, control price, keep it pretty steady, a little more selling here. People are getting depressed because it's not going up. All of a sudden, high frequency traders go, oh my gosh, we found the dark pools, and they push price up, and then another platform forms because the dark pools aren't through yet, and they're saying, okay, we can still get in at that price. There's a little bit of selling, but this is small lots selling at a bad time because you can see that they catch the price. Dark pool activity catches that price, and then eventually it'll move on up. And you can see a lot of different things going on with this stock. Dark pool activity, quiet accumulation, consistency in TTVA, which shows us dark pools moving in, and TTVFF also showing very consistent accumulation over time in this stock. Okay, this small selling off is just due to a very brief period of selling that they thought the stock was going to break through that, and it didn't because dark pools were still accumulating. So the high frequency traders can't see the dark pools, and they make mistakes sometimes. Okay, who is controlling price? Again, we have a huge white candle, high frequency traders. We have a shift of sentiment from TTQA, from panic selling by small funds and small lot investors. Accumulation is going on by the dark pools. They develop the bottoms. Even as the small funds continue to sell at the lows, that's a shallower pattern, and TTVA is also showing good quantity patterns. So we're here at this certain price point, and we can see that it's right at this resistance level for the bottom. So this line is showing the resistance level for a completed bottom, and it needs to break to the upside. And the dark pools are starting to move in, and they've been buying consistently, even though there's been some small fund selling, and they have been consistently moving into this stock, creating this bottom and forming very nice pattern for this one to break up. Okay, we're going to simulate trade. Let's have a little fun here. So we have a stock, and it has been hitting its resistance level over and over and over again. We have a shift of sentiment right there. We have a high frequency trader failure. They were buying. Dark pools were buying when high frequency tried to get in. Small funds tried to sell off because they had a panic mode. They reacted to the high frequency trader action. But now we have a move up. We have another shift of sentiment. We have a small shift of sentiment starting right here. We have TTVA turning up, TTFF turning up, and we have another attempt to move out of this bottom with a reasonable volume. So your task right now is, right on your chart, decide, do you think the stock is going to move up or is it going to retrace? Write that down. And it moves up. Right there. So the stock moves up, and does it move up on dark pool activity or high frequency trader activity? It moves up on high frequency trader activity. You have a longer candle than normal, you have high volume, you have a surge of TTQA, and a surge in the other indicators that we've written for MetaStock charting software. And by the way, they are only for MetaStock. So you have a surge of activity. So if you're in this stock, if you put an order in at the high of that support level, if you're in the stock, would you hold or would you take your profit? You have to write down what you're going to do. We are simulating trading this stock, and you have to determine what the next step will be. You know that the momentum is to the upside. You know that there's a lot of speculation going on in the market because I told you so in the morning when I wrote the market condition analysis for you. Okay, now we have an indecision candle that formed. So what this is the dark pools haven't quite finished with their accumulation, and the high frequency traders came in and tried to sell it down. So then you have an indecision candle that forms. You still have excellent volume. You have strong TTQA, strong TTVA, and TTFF. So this stock could continue to move up. Your decision is, should you buy, or do you think that indecision is enough that it will shift it to a sell side, a retracement? So you have to decide what you want to do. So write it down on your chart. And the stock retraces. Now you have the question of, is it going to break through that support level, that line that I have right there? Is it going to break through the support level and do another retracement? Is it going to go down? What you need to do is you need to look at the volume. Is the volume above average or below? Are the TTQA lines still green, or are they turning red? Has this dipped below its center line? Has this crossed through its moving average? Those indicators tell you how deep this retracement is likely to go. So make a decision. Do you want, if you're in it, do you want to exit it? If you're not in it, do you want to place a higher order? You always want to buy into strengths. Never, never use limit orders. The limit orders make your brokers lots of money. That's why they keep telling you to do it. Okay, now the next day, we have another move down. You want to look at your indicators. Make a decision. If you're in the stock, do you want to continue to hold the stock or do you want to sell the stock? Is it going to cross through that barrier or is it going to hold? Make a decision. This is just like you're on your own and you're trading every day. You're swing trading this stock. You got in. You have to make a decision. You got your support level at this line right here. Is it going to go through it or do you want to continue to hold? Okay, a couple more days of consolidation. So what's happening here? What's going on that you need to pay attention to? We have volume returning to the upside. We have TTQA rising. This is slightly below, but it's starting to turn up, and this is still way up. So what are my volume indicators telling me that my price is not telling me? Write it down. Are you going to stay? Are you going to enter? Make a decision what you're going to do with this stock. You're going to buy into it. You're going to get out now where you have a tiny bit of profit. Make a decision. And you can see that the next day, the stock actually gaps up. Why does it gap up? Because there was pressure building from some dark pool activity during this consolidation period. They control price. So using price indicators isn't going to help you much. If you want a high-frequency trade with the high-frequency traders, you have to trust the volume indicators that are designed to track these guys and get in here or here before this big gap up. Or you're going to miss the whole thing because they don't stay in stocks long. A day, 2 days, and they're gone. Okay, so this is our second simulated trade. We have a similar situation where we have a resistance level that the stock is trying to break out of after a bottoming action. And we can see that we have lots of quiet accumulation going on. We have some high frequency trading going on out of this because they're chasing the dark pools and it's kind of quieted down. We have a turn up here. We have a turn up here. So we're taking a look at this to decide. Right here, we're looking at this. We're looking at this push. This is a push candle pattern. This is a newer candle pattern that most of you have not read about in your candlestick books because it's a newer candle pattern that's developed recently. This is a push. So you would want to enter somewhere above the highs of this. You always want to buy into strength. You do not want to buy into weakness. You do not want to use limit orders because that makes you buy into weakness. So your decision is this stock ready to break out or is it already overextended and is it time for it to do a retracement? You need to make this decision and decide because you will either enter the stock here or you will wait to enter the stock later or you will decide this is a bad choice all around and you don't want anything to do with it. So write it down on your charts. The stock moves up and what does it move up on? High frequency trading activity. We had an enormous amount of dark pool activity in here. This is negligible. Some short-term profit taking. Dark pools were actually buying because their range was pretty large in here. It was a 2 to 3 points, which is pretty common. About 10% is their range. And we had some more accumulation with high-frequency traders chasing. The high-frequency traders got a hold of them. So anytime you see this, you're going, okay, they knew that they're accumulating here. This is something to ignore. And all these patterns are strong. So high-frequency traders are likely to push into this right here. So you're in the stock or you're not in the stock. If you're in the stock, are you going to hold? Where are you going to put your stop loss? You're going to put your stop loss intraday, make it tight. Are you going to give it room to breathe? Are you going to sell the next day? Make a decision on what you're going to do because this is how trading goes. This is what you have to do when you're swing trading. Every single day you're in a stock. Make a decision. Okay, over the next few days, the stock overlaps and runs up more. And it's running up on lots of volume, lots of TTQA, everything's pointing upwards. So this stock has a lot of activity going on behind it. So it's really moving with a momentum action. It's not really velocity. This is a velocity run. This is a momentum run. And so it's moving up. So do you think you should take profits now? Is it time to exit the stock and take your profits and move on, or can it move further? You have to make a decision, decide, write it down. Okay, are you ready? Indecision day. The high-frequency traders don't stay in a stock for long. You can see the huge surge of red volume. But you can also see that even though you have an indecision day, some other late-come dark pools, some activities, some pro traders are in here buying. There's some heavy buyers going into this stock still, even though this indecision day. So this is the battle between high-frequency traders trying to sell it down and large lots still buying. And that's what you get is that indecision day. So that's what you see. But you can see that your indicators, except for, of course, the huge red volume of the attempt to sell it down, are all still angling up. So either you're still in the stock or you're out of the stock. If you're still in the stock, are you going to hold, or do you think it's going to continue to retrace? Make a decision. You're either in the stock and you're going to hold, or you're going to in the stock and going to sell, or you're out of it and you've made a small amount of profit. Unengulfing white. Wow. Okay, and look how nice and neat and precise this price pattern is. And look at your indicators. So, if you're not in the stock, do you want to get in it now? Make a decision. If you're in the stock, are you going to sell and take your profits? Decide what you're going to do. Okay? Next day, another very, very consistent pattern. What's this forming here? What is this? This is a nice little wide consolidation, very precise. Now, who creates these precise highs and lows? You've learned it today. And you got it. Dark pools do this. So you have dark pool activity. You have a very consistent platform consolidation. Now we go the next couple of days, and what do we have? Very, very, very small candles. It's compressing. Oh, but it's to the downside. It's lower. These are lower. Is that a problem? Do you think you should sell out? Make a decision. Maybe you want to buy. Maybe you want to sell. It is a compression pattern. You can see the compression pattern forming. I call them compressions. I don't call them wedges because a wedge is driving force between two items to pull them apart. A compression pattern is like a spring that's being compressed. And once that spring is released, there's going to be a lot of activity. So now you have to decide. You have a real compression. The compression pattern can't get much tighter. When you see this kind of chart, if this comes up in your explorations, you need to really act on it. You need to look at your indicators. You need to say, what is going on here? You've got above average volume and you've got nothing going on in price. That's why price indicators are not terribly helpful. TTQA is still good. This is turned up. This is turned up. So what's going to happen? What do you think is going to happen next day? Are they going to sell down or is it going to move up? Make a decision. And we have high frequency trader activity. Big, huge candle. It's a very common pattern we see nowadays. So this is what you see a lot of. And the stock moves up a little bit after that because the smaller lots are now running in. And you can tell because volume declines. This can be higher because there's lots of little buys going on the small funds. Okay, let's summarize. High frequency trading occurs in all types of stocks, from low price small caps to big blue chips. They are not particular. Their activity is easy to identify with volume bars, TTQA and TTVA or TTFF, with long candles or long wick and tail candles with a small body. That's what they usually do. HFTs and bottoming formations are chasing the dark pools, which is often a continuation pattern, which means they're moving it out of the bottom to the upside. So if a bottom is formed, they're moving it up. HFTs use retail news to trade against small funds and retail traders who use news to buy or sell a stock. This is often a contrarian pattern. This is usually a one-day event. HFTs are often chased by smaller funds at highs or lows, which is often a contrarian pattern also. Smaller funds chasing HFTs can create a reversal pattern. Okay, that's the end of my thing. For those who don't know about TechniTrader, we're strictly an educational company. This is what my partner Howard and I do in our retirement. We've been doing it for a number of years. We have huge success with our students. I have over 50 courses now that I have written over the years that are available. And I teach everything from the brand new person to CFAs, brokers, and everybody else. We have mentoring groups for MetaStock, and we have MetaStock tools. We call them scans, but they call them explorations. We have our hybrid indicators and market condition and so on and so forth. So if you want more information, this is our blog for our mentoring clubs. We always have mentoring clubs for our MetaStock students, and this is where you would get your market condition analysis every day. And if you want more information or if you want to download the workbooklet for this session, just go to technitrader.com. Thanks for joining me today. I hope you learned a lot and had a lot of fun. I sure did. Do we have any questions?
Martha, we had a question. Is there a company capitalization limit below which dark pools don't show interest in a stock?
They have a tendency not to go with the very, very, very small companies. What you want to do is go to Reuters and get a hold of their institutional holdings numbers and track them by their percentage of institutional holdings. If they fall below 20%, then you need to be wary of that, and also watch how many small funds are invested versus the giants. There's about 25 giant funds, and you want to really be with them. They're the dark pools.
And Ray had a question. Does this also apply to futures and currencies?
No, because futures and currencies do not have volume. They are in those markets, but you can't track them the same way you can track them in stocks.
Do you look at CME level 3 data?
CME, yeah, you can, yes, you can. And sometimes they're exposed. But remember, the dark pools they have two places that they tend to show up. They'll be right at the end of the day, the last minute or last 5 minutes, their orders will be entered into the charting software that you have. And sometimes they're pre-market, so they're buying a little bit before the market opens, and then that's part of the open market volume and activity.
Does this same kind of analysis work for intraday trading?
Yes, it does. Yeah, you can follow your high-frequency traders, but you have to remember that dark pool activity does not show up intraday. It shows up at the end of the day. So what you're going to be doing is you're going to be analyzing your end-of-day activity, the last minute or 5 minutes of the activity, looking for that dark pool signature, that footprint, and then planning, because the dark pools will get in end of day, and then you can get ready to try to get in the next day and go with them. So it's a little bit different intraday trading than it is for swing.
And this kind of analysis can be used can be used on ETFs as well.
Oh yes.
Indexes.
Oh yes. Anything that's traded in your stock market, your options, ETFs, any of your derivatives, ETNs, all of this works. All of these work very well for those. You have to have a volume. You have to have volume in your whatever trading instrument you're using. As long as there's volume, this stuff works.
It looks like it for today.
Okay, great. Well, thanks everyone for joining me today. I hope you learned a lot. If you have any questions, you can always reach us at info@technitrader.com. Thank you, and have a good evening. Bye-bye.
Thanks, Martha. Thanks to your whole team. We so appreciate having you in our webinar room. Always a good friend of TechniTrader, and we're glad to have you here today. Thanks, everybody. Please visit TechniTrader at technitrader.com. Download your booklet and definitely get that information from them. Thank you for joining us today, and we'll go ahead and sign off.